If silver touches $1,700, it will not be just a price movement. It will be a signal, a warning, a flashing red light in a financial system already stretched to its limits. Most people are trained to think in small numbers, $20, $30, maybe $50. They think silver is a quiet metal, slow, boring, secondary. But history does not treat silver as secondary. Silver is monetary memory. Silver is industrial necessity. Silver is systemic pressure made visible. And when silver makes an extreme move, it does not whisper. It exposes stress fractures underneath the global financial architecture. Right now, the foundations of the monetary system are under pressure from multiple directions at once. Before you go any further, make sure you like this video, subscribe to the channel, and turn on notifications so you never miss what's coming next. Drop a comment below telling me where you're watching from and what time it is in your country right now. Now, let's return to the topic. Debt levels across developed economies are at historic extremes. Not just high, structurally unsustainable. Governments are refinancing trillions at higher interest rates than they've seen in decades. Every percentage point increase in rates multiplies the cost of servicing that debt. When debt servicing crowds out productive investment, growth slows. When growth slows but spending remains elevated, deficits expand. When deficits expand, more bonds are issued. When more bonds are issued in a market already saturated, yields must rise to attract buyers. Higher yields tighten financial conditions. Tighter conditions pressure equities, real estate, and leveraged institutions. This feedback loop is not theoretical. It is mathematical. Now ask yourself this. What happens when the market begins to doubt that debt can ever realistically be paid down without currency debasement? That is, when precious metals stop trading like commodities and start behaving like monetary insurance. Silver is unique in this dynamic. Unlike gold, which is primarily a monetary metal, silver sits at the intersection of monetary demand and industrial demand. It is essential for solar panels, electronics, medical equipment, and emerging technologies. Industrial usage has grown consistently, while above-ground investment stockpiles remain relatively small compared to gold. This dual role creates a tension. In a strong economy, industrial demand lifts silver. In a weak or unstable monetary environment, investment demand lifts silver. If both forces align at the same time, tight supply and rising monetary fear, price dislocations can become explosive. The $1,700 level would not represent normal appreciation. It would represent systemic repricing. For silver to reach that zone, something deeper must be happening. Perhaps bond markets have lost confidence. Perhaps currency volatility has accelerated. Perhaps inflation, once declared defeated, has reemerged more aggressively. Perhaps trust itself has fractured. Consider inflation not as a headline number, but as a behavioral shift. When households and businesses believe prices will continue rising, they change their behavior. They accelerate purchases. They demand higher wages. They renegotiate contracts. This embeds inflation into expectations. Central banks can raise rates, but if inflation expectations are unanchored, rate hikes can paradoxically increase stress without restoring confidence. Confidence is fragile. It rests on the belief that the system is managed, controlled, predictable. When silver begins to surge dramatically, it often signals that predictability is fading. We have seen periods in history where silver moved far beyond what analysts considered reasonable. Each time, it was dismissed as speculation, until it wasn't. The structure of today's financial system is more leveraged, more interconnected, and more dependent on continuous liquidity than ever before. Liquidity is the oxygen of markets. When liquidity flows, risk assets rise, credit spreads tighten, and volatility compresses. When liquidity dries up, the opposite happens. Assets reprice violently. Now imagine liquidity tightening while inflation remains stubborn. That is the most difficult environment for policymakers to navigate. They cannot ease without risking currency weakness and renewed inflation. They cannot tighten without risking recession and debt instability. Silver responds to that tension. The idea of $1,700 silver forces us to confront a larger question. What would need to break for silver to be revalued at that magnitude? Supply is one side of the equation. Silver mining output has not expanded at the same pace as industrial demand growth. Many primary silver mines operate with thin margins, and much silver production is actually a byproduct of mining for other metals. That means output cannot simply ramp up in response to higher silver prices. At the same time, investment-grade physical silver inventories are finite. Paper markets, however, are not finite. Futures contracts, derivatives, leveraged positions, these create the illusion of abundant supply. But paper supply depends on trust. Trust that contracts will settle smoothly. Trust that counterparties remain solvent. Trust that delivery mechanisms function as designed. If that trust weakens, paper claims can disconnect from physical reality. That is when price discovery becomes unstable. The $1,700 number symbolizes a potential break between paper pricing mechanisms and physical demand pressure. It would suggest that investors are no longer satisfied with exposure through financial instruments alone. They would be seeking certainty. Certainty in possession, certainty in settlement, certainty outside the digital financial grid. And that shift from convenience to certainty is powerful. We live in an era where financial assets exist mostly as digital entries. Bank balances are numbers on screens. Retirement accounts are electronic statements. Bond holdings are ledger entries. If volatility intensifies and counterparty risk rises, some capital will move toward tangible assets. Not because they generate yield, but because they do not require someone else's promise to exist. Silver's affordability, relative to gold, makes it psychologically accessible. In times of stress, that accessibility matters. When smaller investors feel priced out of gold, they turn to silver. When institutional investors seek diversification into hard assets, silver's liquidity makes it viable. This combination can amplify momentum. Now consider the geopolitical layer. Global trade tensions, resource competition, sanctions, and currency blocks have reshaped international finance. The assumption that the global monetary system will remain stable indefinitely is being questioned more openly than at any point in recent decades. When nations diversify reserves, when they reduce reliance on certain currencies, when they accumulate strategic commodities, that behavior reflects long-term hedging against systemic uncertainty. Silver is not typically discussed in official reserve statistics the way gold is, but industrial demand tied to energy transitions and technology infrastructure creates strategic importance. Energy systems of the future rely heavily on silver-intensive components. If governments pursue aggressive infrastructure expansion, while private investors pursue monetary hedges, supply tightness can intensify. A price like $1,700 would imply that these forces converged dramatically. But price is not the ultimate focus. The signal is. When markets reprice aggressively, they are communicating something about risk. In 2008, bond spreads signaled stress before equity markets fully understood it. In 2020, liquidity stress signaled vulnerability before broad recognition. Silver at $1,700 would be a message about trust in currency purchasing power and financial architecture. Some will argue that such a price is impossible, yet impossibility is often a reflection of current perspective, not structural limits. Currencies have lost value repeatedly throughout history. Asset classes have repriced beyond expectations many times. What seems extreme in one decade becomes normalized in another. The real question is not whether silver can reach $1,700. The real question is, what conditions would make that price rational? Hyperinflation? Currency restructuring? Massive monetary expansion? Severe supply shock? A global loss of faith in sovereign debt? Any one of these factors alone might not be sufficient, but layered together, they create non-linear outcomes. Financial systems tend to function normally until they don't. Stability breeds complacency. Complacency breeds leverage. Leverage breeds fragility. Fragility eventually meets a trigger. And when that trigger arrives, repricing is fast. If you hold silver, you are not holding a lottery ticket. You are holding optionality. Optionality against currency dilution. Optionality against systemic breakdown. Optionality against policy error. However, optionality only works if you understand why you hold it. Blind optimism is not strategy. Panic is not strategy. Preparation is strategy. If silver were to accelerate toward unprecedented levels, emotional reactions would dominate headlines. Fear of missing out, fear of collapse, fear of currency devaluation. But emotional cycles do not create wealth preservation. Discipline does. In the face of volatility, clarity matters more than excitement. This is not about predicting an exact price. It is about understanding structural vulnerabilities. It is about recognizing that the global financial system is navigating the most complex cross-currents in decades. Record debt, persistent inflationary pressure, geopolitical fragmentation, supply chain fragility, energy transitions, demographic shifts, technological disruption. Each of these forces interacts with the others, and silver sits quietly at the intersection of many of them. If $1,700 silver ever becomes reality, it will not happen in isolation. It will occur in an environment where traditional financial assumptions have already been challenged. The earlier you analyze the structural trends, the less reactive you will be if volatility intensifies. The purpose of this alert is not to incite panic. It is to provoke awareness. Markets reward those who prepare before headlines scream. Silver is not just a metal, it is a barometer. And if that barometer moves to extremes, it will be measuring far more than supply and demand. It will be measuring confidence itself. If silver were to surge towards $1,700, The environment surrounding that move would not be calm, orderly, or easily understood. It would be volatile. Headlines would conflict. Analysts would scramble to explain what just happened. Some would call it a bubble. Others would call it a reset. Many would be caught unprepared. But disciplined investors do not wait for clarity after the move. They prepare during uncertainty before it. To understand how to respond, you must first recognize that extreme price levels are symptoms, not causes. A dramatic repricing in silver would likely reflect deep structural stress across multiple asset classes simultaneously. Bond markets may already be flashing warning signals. Credit spreads could be widening. Equity valuations might be compressing. Currency volatility may be rising. Liquidity could be fragmenting across regions. When confidence erodes, correlations change. Assets that once moved independently begin moving together. Diversification models built on decades of stability can fail quickly when systemic risk emerges. In those moments, hard assets behave differently. They are not dependent on earnings projections. They are not priced on discounted cash flows. They are not liabilities on anyone else's balance sheet. They are tangible. That tangibility becomes psychologically powerful when financial instruments feel abstract and unstable. However, it is critical to separate long-term structural positioning from short-term speculation. If silver accelerates violently, volatility will expand dramatically. Daily price swings could become extreme. Premiums on physical products may detach from quoted spot prices. Supply chains could tighten. Delivery delays could extend. The gap between paper contracts and physical availability might widen. In such conditions, emotional decision-making becomes dangerous. Chasing parabolic moves late in the cycle can expose investors to sharp corrections. At the same time, dismissing the move as irrational without understanding the underlying drivers can lead to missed strategic shifts. The key is understanding why you hold silver in the first place. There are generally three primary motivations: monetary hedge, crisis insurance, and speculative upside. A monetary hedge protects purchasing power against currency dilution over long periods. Crisis insurance protects against systemic breakdown or counterparty risk. Speculative positioning seeks profit from price appreciation. If $1,700 silver becomes reality, the motivation behind your position determines your response. If your objective is crisis insurance, then price is secondary to possession and security. The focus remains on safeguarding, not trading. If your objective is monetary hedging, then you evaluate silver relative to other real assets, inflation trends, and currency stability. If your objective is speculation, then risk management becomes paramount. Position sizing, liquidity access, and exit planning matter more than narratives. Extreme price levels test discipline. One common mistake during explosive rallies is concentration risk. When a single asset dramatically outperforms, portfolios can become unintentionally unbalanced. Rebalancing during strength is emotionally difficult, but strategically sound. It converts volatility into stability. Another critical factor is liquidity access. In a high volatility environment, market access can change rapidly. Brokerage restrictions, margin requirement increases, trading halts, and capital controls are not theoretical possibilities. They have occurred in various forms across markets and jurisdictions throughout history. Physical ownership reduces certain risks, but introduces others, including storage, security, and liquidity timing. Financial instruments offer convenience, but rely on intermediaries. Understanding the trade-offs before stress intensifies is essential. Now consider the macroeconomic backdrop that could support such a price. Persistent inflation that remains above target despite tightening policies would strain credibility. If rate hikes fail to restore price stability while simultaneously slowing growth, stagflationary conditions could emerge. Stagflation is particularly challenging because traditional policy tools conflict. Stimulus risks fueling inflation. Tightening risks deepening recession. Confidence erodes as policymakers appear constrained. In that environment, hard assets often outperform financial claims. Additionally, sovereign debt sustainability becomes a focal point. When debt to GDP ratios climb while growth stagnates, refinancing risk increases. Investors demand higher yields to compensate for perceived risk. Higher yields increase fiscal strain, creating a feedback loop. At some point, authorities may face a choice between austerity, default restructuring, or monetary expansion. Monetary expansion is politically easier than austerity, but it dilutes purchasing power. Silver responds to dilution expectations. Currency competition adds another layer. If major economies pursue divergent monetary paths, exchange rates can swing sharply. A weakening currency raises the domestic price of globally traded commodities, including silver. Now imagine multiple major currencies weakening simultaneously due to synchronized fiscal stress. The repricing would not be isolated. Industrial demand cannot be ignored either. Energy infrastructure transitions require significant silver input. Solar expansion alone consumes large volumes annually. Electronics, electric vehicles, grid modernization, medical technology all rely on silver's conductivity and antibacterial properties. If industrial demand remains firm while investment demand surges due to monetary fear, supply elasticity becomes critical. Unlike digital assets, silver cannot be created by code. Mining requires capital, labor, energy, and time. Environmental regulations, geopolitical instability in mining regions, and rising extraction costs constrain rapid output expansion. Therefore, a demand spike can overwhelm short-term supply flexibility. Inventory drawdowns amplify price moves. In addition, the structure of futures markets can accelerate momentum. When short positions are forced to cover in a rising market, buying pressure compounds. Algorithmic trading systems can amplify volatility. Trend-following funds add fuel once breakout thresholds are breached. Momentum becomes self-reinforcing. But momentum cuts both ways. After extreme advances, corrections can be violent. Leverage unwinds quickly. Late entrants panic. Liquidity gaps appear. That is why preparation matters more than prediction. Preparation includes diversification beyond a single thesis. It includes holding sufficient cash reserves to navigate volatility. It includes minimizing leverage. It includes understanding tax implications before major gains occur. It also includes mental preparation. Watching an asset multiply in price can create euphoria. Watching it retrace sharply can create despair. Neither emotional extreme supports rational decision-making. Zoom out. If silver reaches $1,700, the broader story will not be about profit alone. It will reflect structural instability in the global financial system. Retirement systems dependent on bond stability may be under strain. Bank balance sheets sensitive to interest rate movements could be stressed. Real estate valuations dependent on cheap financing may be correcting. Corporate earnings may be pressured by higher input costs and weaker demand. In that environment, preserving purchasing power becomes more important than outperforming benchmarks. Hard assets play a role in that preservation. However, silver is not a complete strategy. It is one component. Food security, energy access, diversified asset exposure, and geographical flexibility all matter in uncertain periods. Financial resilience is multidimensional. Some investors will ask whether such extreme pricing would signal an imminent reset of the monetary system. It is possible that significant commodity repricing would precede policy shifts, including new currency frameworks, digital monetary experiments, or coordinated restructuring agreements. Monetary history shows that regimes evolve during stress. Fixed exchange systems have transitioned to floating systems. Gold standards have been abandoned. Capital controls have been imposed and later removed. Systemic change rarely occurs during calm expansion. It occurs during crisis. If silver's price were to reflect profound distrust in fiat stability, policymakers would respond. Responses could include tighter regulation of commodity markets, windfall taxation, emergency liquidity programs, or coordinated international agreements. Therefore, holding silver is not merely about price upside. It is about understanding how it interacts with policy response. Strategically, investors must avoid binary thinking. Silver will not move in a straight line from current levels to $1,700 without retracement. Markets move in waves. Accumulation during periods of neglect often proves more effective than chasing during frenzy. Risk management during strength preserves longevity. Flexibility during uncertainty enhances survival. The overarching principle is this: wealth preservation requires adaptability. Rigid conviction without reassessment is dangerous, but constant reaction without conviction is equally dangerous. Balance is essential. If the world experiences severe monetary stress, assets tied purely to financial engineering may struggle. Assets tied to physical reality may outperform. Silver bridges monetary history and technological future. It has been used as currency for thousands of years. It is embedded in modern industry. That dual identity gives it resilience across different economic regimes. A $1,700 price would symbolize not just appreciation, but transformation. Transformation in how markets value trust, scarcity, and tangibility. The purpose of this discussion is not to predict a date or guarantee a target. It is to recognize that the global financial environment contains vulnerabilities large enough to produce outcomes once considered extreme. Ignoring those vulnerabilities does not eliminate them. Preparing for them does not require panic. It requires awareness, discipline, and strategic allocation. Silver owners must think beyond price charts. They must evaluate storage security, jurisdictional stability, portfolio allocation percentages, and liquidity contingencies. They must consider how silver fits within a broader resilience framework. They must understand that extreme opportunities and extreme risks often arrive together. In times of systemic stress, the difference between those who preserve wealth and those who lose it is rarely intelligence alone. It is preparation. It is discipline. It is emotional control under pressure. If silver accelerates toward levels few currently imagine, the headlines will come after the move is well underway. Preparation must come before. If $1,700 silver ever becomes reality, it will not simply represent a profitable trade. It will represent a profound message about currency stability, debt sustainability, and global confidence. Those who understand the signal behind the price will not react with fear or euphoria. They will act with clarity. They will recognize that precious metals are not about hype, but about protection. And in a world of rising uncertainty, protection is not optional, it is essential.